Hi, guys. Thank you for tuning in for part two of Punk Macro. And this week, I give the stage over to Tom, who has written what I believe is an excellent essay on the signs of the zodiac, on zodiac time, and the differences between China's timekeeping via the astral galaxies and our own Western version, which both involve 12 characters. Our system is rapid. It has the animation of our Western lives, and it takes 12 months, whereas we forget, or at least I did, that the Chinese zodiac is much slower moving and requires 12 years. And Tom's paper made me reflect. What was I doing 12 years ago? Let me tell you. In March 2009, I took a very slow train into the center of China, to Wuhan. I made some videos of remarkably expensive, just completed skyscrapers that would actually be exceptional if you were to see them in Manhattan. And there they were in Wuhan, which of course now is infamous for its wet market. And I kind of labored on this notion of overcapacity, of too much building. And I set in train a process which saw me launch a blow-up fund. And I thought if China, we were so leveraged with credit default swaps, and actually we were buying Australian 10-year government bonds, which were yielding 6% at the time. Can you believe? As everyone back then, like today, thought that the world was going to replicate Weimar, we're going to have huge inflation. How things did not turn out as prophesized. And likewise for me, I thought I was going to make the Soros $1 billion on my trade, but I was wrong. And Tom offers a remedy. The remedy was that my clock was poorly calibrated to the slower cycle of the Chinese model. And the glaring point is that the cycle now has completed its rotation of 12 years. We now find ourselves in the ox, and I don't really see any indications of bullishness. Markets over there are at best, equity markets flat. The bullishness would be the currency boosted by COVID, boosted by the trade surplus, and COVID et al. Taking it back to very high levels of GDP, the surplus to very high levels of GDP. And investors like myself, or speculators like myself, have largely given up the ghost. We were too early, and like the boy who cried wolf, no one is prepared to entertain our thoughts. So with that, let's give it over to Tom. Let's hear what he's got to say, and I'll probably add a few comments on Twitter once we got this thing published on YouTube. Thank you very much.
Now, the last time, we were talking about Chinese property, and I don't want to go overboard, but my God, Sesame, this is really okay. I speak too much. Tell me about you. You wrote a fabulous paper, right? Why don't you tell me about the analogy you made with the timekeeping or the calendar system of the Chinese versus how we look at things, and how that could account for and explain where we are today?
Well, to start with, can I just come back on the Pattis thing?
Yeah.
Because I actually think that the Pattis argument about China repressing its wages actually feeds into the property thing.
Yeah.
So China for a long time has repressed its wages, and as a result has continued to be more competitive than it would have been otherwise. And it has essentially dampened its own demand of both of its own stuff and of stuff from the rest of the world. And, when you have your old kind of savings plus investment identity, savings plus consumption identity, if you don't consume, if you repress consumption via repressing wages, you increase savings and you increase investment. And that's what's happened in China. They have basically remained extra competitive on a global stage, and have instead deployed the revenue they've created in their own investments. And for a long, long time, that actually worked really well, because basically, China had a growing population. It needed to fund all of this urbanization. People needed to move from the agrarian interior of China onto the East Coast. And so a lot of infrastructure was needed. And, in the past, when you've seen crashes in Chinese, when you've seen issues with Chinese infrastructure, particularly in the case of housing, it's never really been that much of a problem, because the pace of urbanization has continued to go. And so you just end up building stuff ahead of schedule rather than actually building too much. And so, this is the direct result of Chinese, the policy of wage repression, which has led to all of this excess investment spending. It all fits together. And so my analogy on China was that, it often feels, when you're looking at charts and things like that as a market participant, you kind of feel a bit like an astrologer, or I think other non-market participants think of you as an astrologer. You're looking at these arcane patterns and weird goings on, and you're trying to extract some kind of truth from it. Whether you can do that successfully or not, sometimes remains to be seen, much as is the case in astrology. But in the West, there's an astrological system which basically has a calendar of 12 months. You have 12 signs, roughly one per month on the lunar cycle, and you have you start a lunar new year and an astrological new year at the same time as the regular new year. Whereas in China, you have 12. Like 12 is the common factor, but you have 12 years to an astrological cycle as opposed to 12 months. And I think that when you think of the way that the Western business cycle is imbued with free market spirits, you're kind of like your bull and your bear, and how these animal spirits drive the business cycle into excess, and then everything crashes, everyone panics at the same time, runs for the doors. You see a market crash until it bottoms very, very quickly, because you have all of these prices send very quick feedback signals to each other. And so everything just happens at breakneck speed. Whereas in China, instead of allowing free market forces to control the economy, you allow mandarins sitting in their ivory towers, tinkering away at the way that they think the economy should look. And, when they get it right, it can be much better, because there's no need to build like three of something. You don't need to have 5 competing companies building the exact same infrastructure, and whoever one builds something slightly better basically has a winner take all. You just build one set of infrastructure and it's take it or leave it. As long as you kind of pick your winners right, it's better. But the problem is you don't have that price feedback signal to tell you when you're going wrong. And so without that price feedback signal, you can kind of continue on this path for a long, long time without realizing that you've got a big, big problem. And I think this is, the time scale at which things happen in China are far, far greater than those in the West, just simply because the feedback of the decision making is very, very slow. Like, basically everyone is pushed into doing a certain thing. If the path is correct, you have a boom, and that boom lasts a long time. And, to a certain extent, it can't get that excessive because there isn't those free market spirits to drive it too much. But then if the state does the wrong thing, eventually you have a massive amount of malinvestment and the whole thing pops. But even on the way down, which I think is what we're seeing at the moment, you're seeing the Chinese property sector slow down. But if you look at the published prices of property, we're not seeing falls. And the reason you're not seeing falls is because local governments do not allow price reductions into the system. And so instead, what you see is sales dry up. Which is arguably worse, because the whole economic machine starts to dry up. You're basically, if you set your price here and everyone knows the real price is 30% below, no one's going to buy, and the system is completely gummed up. Property developers have no incentive to build because no one wants the properties at the price at which they're forced to set the price at. And so what do? This isn't really a problem if you've got this huge pace of urbanization growth which carries on, because time will bail you out. But Chinese population growth has now slowed to a halt. Urbanization growth is actually not very far behind. You have a vast glut of unfinished properties, and on top of that, you have a vast glut of properties which no one is living in. Not only does no one live in them, they're not even like finished in their interior, because they are purely designed as an investment vehicle for a Chinese populace who has very little alternative but to invest in this stuff. And so, here we are. 12? Let's say that the last major Chinese boom cycle started in 2009. You could say it started in 2007. I don't really know. It's lasted an awful long time. Western analysts have basically been like, it's going to blow. It's going to blow. If China was run on a Western style system, it probably would have blown in 2014 and 2016. It didn't, because the state essentially makes the decisions. But the problem is, they should have stopped. They should have stopped building. They did not stop building. They continued building. And the local governments were in charge of this process. They were complicit in it because they got a significant portion of their revenue from land sales. And so they were incentivized to keep land sales high and to push the property developers to keep on going. And, they made sure that the local banks, which are under their control, lent money to the property system. At the same time, the system tried to offload as much of the risk as possible to the Western world at extremely high interest rates, which have gone up and up and up, and have now got to the level where it is essentially impossible for a Chinese developer to issue paper outside of China. And so, there's a certain amount of the problem they've managed to offload on non-Chinese citizens, but actually not that much. Most of it sits within the Chinese banking system. And given the scale of the problem, given the vast amounts of access, given the slowdown in demographic growth, time is not going to bail us out this time. And so I'm very, very worried. So far, there's been essentially no contagion from the Chinese property system to other assets within China or to other assets globally. That to me seems very surprising, because I think, on the short term, if there's like a small issue in China, if you have like a growth slowdown, if you have, in the West, let's say you'd have like a 2% negative GDP recession or something, that's just smoothed over in China. The money comes out and it doesn't appear. But when you get the big one, it can't be smooth. And so it takes an awful lot longer for the cycle to play out in China. But when it does, it is big. And I think that's where we are now.
And why that rings true is the apathy. These seem very legitimate, but people are right. They kind of say, you told us that 10 years ago, but actually 10 years ago in your Chinese clock that was earlier this afternoon, It wasn't 12 years ago. Yeah, it was relevant then. It wasn't relevant in our time frame, and it's very relevant now in the Chinese time frame. You read, again, papers. One of the front page articles this week was, guess what? Overseas investors have never had more money invested in China. They've just put a barrel load in. I mean, when you go back and you look at massive pivot points in history, you will find that institutional investors were not looking very smart with what they were doing. The boring thing, and actually I was just looking at the dollar CNH, and again, it's kind of like all markets are the same, because you had a massive appreciation in the renminbi from like 690 to 640 versus the dollar. And kind of, I want to say, absolute levels didn't peak, but in terms of momentum levels of that movement in the yuan being stronger, it was the end of February, beginning of March. Again, it was kind of, you had treasuries running up to about 160. You had a whole host of capital markets equity markets all doubled. Now they've continued, but then the kind of more serious markets, the bond markets and this currency have gone, okay, that's kind of, so you've got this uneasy calm. And for sure, despite, I mean, the news this week is all about liquidity. So like you had brought to our attention that the Chinese property model was fantastic for the equity owners because it allowed you to clear the risk very, very quickly. The turnover of risk was immense because I think as long as the building was 1/3 constructed, you could get all of the money. And
yeah,
they've changed that now. You've got to put the roof on before actually those. So what they're doing is they're just stopping the liquidity coming in, and like you say, they are stopping market price finding a level which creates transactions. Transactions. I think I read Evergrande's transactions between September and October, so 2 months of the year, were 1% of what they did in the entirety of the previous year. And I mean, that speaks volumes. But from a risk-taking perspective, it's lonely just now. There's no confirmation of that. There's just a kind of uneasy calm. I don't know if you're being active there or there's not much you can do yet.
Well, so yeah, like I think that dollar CNH is difficult because you are seeing massive trade surpluses because China is not really buying a lot and it's exporting more than ever.
But its economic momentum has really been on the wane all year, no? In terms of it went up like a rocket ship once you started the anniversary of all the COVID data. And then once you got a year past that, they were first out. And so they were the first ones to get a calendar year of like being on a kind of revised, restored level. And then it's kind of, all the metrics I see, it looks no stronger, if perhaps weaker than it was in the year before COVID, to 2019.
Yeah, it's not that, like as a percentage of GDP, it's not that huge anymore. I think the levels in dollar terms actually only just exceeded what we saw in 2008. But of course, at that time, the Chinese economy was much, much smaller in early 2008. And so we're back to the same place in terms of dollars, but actually something like 2%. There's a trade surplus of something like 2% in China. But there just seems to be a lack of appetite to take on yuan shorts against that trade surplus. I think, Western investors, as, much like that astrological analogy, they basically feel that they were wrong and are no longer seeking to short China's economy. And, my argument against them is they weren't wrong. They were just looking at the wrong clock. Their timing was off. And now, just as the timing, in my opinion, is right, they're not interested. To be fair, there's a lot of other interesting stuff going on in the world economically. There's so much, when you look at the Green Revolution, when you look at the inflation debate in the West, when we've got rate hikes. Do we have rate hikes? Do we not have rate hikes? There's an enormous amount of other stuff going on. And so, I think if we were in a more boring world, Western speculators might be more inclined to short China, but we're not in a boring world. We're in quite an exciting world from a macro perspective at the moment. There's an enormous amount happening. And so, but in a way, this is like the perfect environment for China to sort of slowly just get worse and worse without anyone really sort of paying attention. The frog is slowly getting boiled and we're not paying attention.
Yeah. That's why, I'm looking for signs of all of that and I guess other markets. So for me, the inflation deflation debate seems to be in public opinion. It's all about we should raise rates, or we're not going to vote for you again as a politician. The Green Revolution, I think, initially is deflationary. It just means, like everything we've seen in Europe with gas prices, it means people on modest incomes like, wow, I can't, winter's coming and I'm going to be cold. I can't pay for it, Now, we could argue that feeds into the need to be paid more, and it could become, but I'm saying deflationary initially, and then maybe inflationary, but deflationary initially.
How is it deflationary initially?
Because it is a very evident and a very sizable increase in the price of a non-discretionary household budget. You can't diminish your consumption. You have to diminish something else, and that's why I'm still in the bond market.
You're basically saying there's crowding out. There's going to be crowding out of other spending, but it's inflationary on certain goods.
Relative prices it is inflation in the prices of non-discretionary items, which makes it like rotten and toxic at a pop cultural level, because you don't like it, but you don't like it because you've got no choice. You got to suck eggs with it. But in terms of why the treasury market is not yielding more than 2% at the 10-year, it's because, well, you know what? Something will break. You consume less of something else until you don't. But that will need to get.
So what can we? So in terms of price hikes because of green movement, I guess we can say energy prices are in that, right? It's a big deal. It's a problem. But like energy consumption, in terms of the percentage of a household budget, is not that high. It's a lot lower than it was in 2008. And I think I looked at what is oil consumption as a percentage of global GDP in terms of cost. I think it's something like 2/3 of what it was in 2008 when the price of oil was like $100, and it's absolutely nowhere near what it was in the 70s. Like, to me, that suggests that at current levels, even if the oil goes back to 100 or even 150, it's probably not that much of a problem. It's probably not a big enough move on its own to cause an economic slowdown. And so I'm not really sure how much substitution there will be. Like, the used cars, big problem as well. Not really sure you can say that's a green energy thing. I think it's just more the car makers just were running on a model which turned out to be inadequate when global supply chains were shaken up. And
used cars have been a positive source of their price have been rising owing to the shortage in cars.
Yeah, but isn't that the same kind of thing that you're saying about oil prices? You're basically saying that inflation causes deflation.
Yeah, I'm saying that
other goods, but you can say the same thing about used cars.
No, yeah, absolutely. A legacy of diesel oil burning cars is one where the collateral value of that car pool is going to diminish, is losing value, probably rapidly, versus the electric equivalent. And that the collateral of your used car, if it's going down, if the used car price is going down, that's going to impact your ability to trade up and to consume more. So yeah, it's deflation.
But by that argument, inflation is deflation.
Inflation. Well, I mean, but that's almost where I am just now. Thank you for that. Inflation is deflationary, because an inflation which causes you to reprice treasuries from 40 basis points to 400 basis points is going to be lights out.
So it's basically bottom up. So basically supply constraint style inflation leads to constrained spending on other things, and should ultimately, unless there's financial elasticity. So hold on. So you get supply shocks, which manifest themselves in relative price highs in typically non-discretionary items. You then need economic commercial agents going, God, this just feels different. Just people are buying these highs. They're not cutting back on other things. They're coming back. My restaurant is still busy. I thought in the month of January, February, when it was really cold and when their electricity bill was really high, I thought they would be consuming less pizzas. I don't know, but the fat boys just can't get enough pizzas. You know what? I'm going to pay more for kitchen staff. I'm going to pay more for servers. That's kind of how you would break that.
And just now, we're still waiting for January, February, the really cold months, and people are going, I'm not paying up for it. And that's why I'm still believing that the treasury market is correct with yields below 2%. And then, of course, it's just, the stock issue of having to reprice something which is 4x GDP, and the consequences of the great financial crisis was the 2008 was a big deal because at its core, US house prices were the wrong price. And US house prices were the stock value of US value of US house prices to GDP is what?
Not entirely sure.
It's a big number. Like, let's call it 50. Let's dial it back maybe 50 times. So it's a huge number. And when you kind of reprice it a little bit, its effect on this GDP thing is immense. All right. When people talk about, you remember they used to get bored with the market's going to crash because of student loans. The market's going to crash because of the car loans. No, it's not, because they're like nothing versus the size of their stock to the flow ratio is insignificant. House prices was a different matter. House prices was really real, and the bond market is really real. So we seem to have what do I want to call it? We're in the forest. We're trying to prevent fires. There's a fire break, an institutional cultural fire break, which does not prevail in Venezuela, did not prevail in Weimar Germany, did not prevail in China and Japan when they had their inflation, did not prevail in some of the other European states when they had their inflation. When I say inflation, I mean like hyperinflation 100 years ago. And did not prevail in the 1970s when the US had its taste of like double-digit inflation. It did not prevail because the 1970s was the epilogue. It was the end of the deleveraging, which was brought into play from the bankruptcy of the US banking system in the years 1930 to 32. So to my mind, inflation, double-digit inflation, is a more relevant risk when the system has completely deleveraged, not when it's at the apex of the leverage, is my contention, which is, I'm not smart enough to prove.
Yeah, I guess it depends on how you measure the leverage, right? Like if you measure the leverage relative to wealth, as we were talking about before, maybe we have deleveraged.
Well, but again, in a world where 5 or 6 techie companies can be capitalized more than the entire market capitalization of Japan, which is, I think, the world's 3rd largest GDP nation, okay, then, and it's only there because they're priced at such an out of range valuation because of where treasuries are. So you take treasuries to 4, I tell you, those 5 stocks will not be 100% of Japanese GDP. They'll be like, at most 10, 15% of Japanese GDP. Now, that'll be offset by the fact that a lot of industrial companies will rise, but, there's we might get there.
Do you think that those companies don't have pricing power?
Which companies?
Those big 5.
I think their valuation is not a function of their pricing power. I think their valuation capitalizations is a function of their robustness to economic shocks.
But let's say we have high inflation, we have decent growth, and you can see in their earnings that they manage to pass that on in cost increases.
Yeah.
Do you think that there's a possibility that they could keep their valuation because whatever inflation or like rise in interest rates happens elsewhere, they can pass it on as monopoly price providers?
I think let's make up a number, 80% of their aggregate valuation model is accounted for by the valuation of US treasuries and by a desire to have risk-free equity collateral. And I think the other 20% reflects, bottom-up dynamics, pricing power, market penetration, technology shifts and changes and stuff like that. And so I think, yes, you could get a 10x improvement in the 20% offset by a 20% deterioration in the 80 is bad news for the overall valuation.
You might be right. I don't know, because I certainly was in your camp. I'm now not so sure because, if they can prove that, their earnings can be, they can raise prices to maintain their earnings, and people sort of project that out, interest rates can rise, and it doesn't actually make that much difference to the valuation because their interest rates rise, they just increase prices more, and the economy is basically forced to take that burden.
Well, to me, I had to write a dissertation on zero coupon securities in my last year of university. There are zero coupon bonds, and in terms of valuation models, and you reprice the interest rate, and boom! But like, who cares? Because it's like, if Treasury yields exceed 2%, then value strategies like the other all the other stocks apart from those five, are the ones to own. I don't see I don't see equity markets being profoundly at risk. Can they fall 20, 25%? I hope so. But you'll find eager beaver buyers if that happens. The market itself is very, very rational. There's a huge buffer of security, which would be the repricing of,
So here's a question for you. Does that shift happen based on nominal yields or based on real yields?
Oh,
because they're very different, right? Like,
no.
Because they're going in opposite directions right now. So I think it's a very critical question.
But I think increases in nominal yields will crush the momentum in inflation, and therefore will rapidly, whatever you see normally, will rapidly feed through into real.
Okay, and you won't see interest rate cuts. Well, I guess we can't do interest rate cuts right here.
Politicians will embark. They will embark on a cycle, and they will be it will have a maturity. It will have a duration. It will, if rates have to come down, they won't come down immediately. The capital risk markets will price the market to tell the central banks, don't do this. We're not seeing what you're seeing, and we typically are better than you at this stuff. And then after maybe 6 months or something, then the central banks will get into line. But these are all hypotheticals, and I think we should stop. I should, the polite host, I should thank you very much for your time on a Friday night. I should commend you on an impeccable microphone and lighting and background stage. And I should.
It needed to be changed, I think. So.
It's all about content, baby. And Tom, thank you very much.
Thanks a lot, Hugh. Cheers. Pleasure as always.
Let's stop this thing. Stop video.